Hey there, and welcome. If you've just inherited an annuity and you're feeling a bit lost, don't worry. In this explainer, we're going to turn that confusion into some real clarity and confidence.
All right, so you've inherited an annuity. Now what? It can feel like someone just handed you this complicated puzzle, right? With all these financial and tax pieces. But we're going to solve it together, piece by piece.
Okay, first things first. Your entire path forward, pretty much everything you can do, boils down to answering just two simple questions. These answers are going to unlock which options are actually on the table for you.
So, question number 1. Are you the spouse or are you a non-spouse beneficiary? This is huge, because if you're the surviving spouse, a whole set of unique doors open up for you. The biggest one? You can basically take over the contract and just treat it like it's yours. Now, if you're a non-spouse beneficiary, say a child or a sibling, the rules are a bit different, a little more structured.
And question number 2 is all about where the money came from in the first place. Is the annuity qualified or non-qualified? Think of it this way. A qualified annuity was paid for with pre-tax dollars, like the money inside an IRA or a 401k. But a non-qualified one, that was bought with after-tax money. And trust me, this little difference totally changes the tax game when you go to take money out.
All right, so now that you know your answers to those two big questions, let's get to the good part, exploring your options. This is where you figure out how you actually get the money and what path you want to take.
Let's talk about spousal continuation. This one's really just for surviving spouses. If you don't need the cash right now, this is often the easiest, smoothest path. You literally just step into your spouse's shoes, take over the whole contract, and let it keep growing tax-deferred. You can even name new beneficiaries for down the road. It's like the annuity just keeps on going.
But, of course, there's a trade-off, right? The huge pro here is that you keep control and you get to push that tax bill way down the road. But, and this is a big but, you're not eliminating the taxes, you're just delaying them. Sooner or later, when that money comes out, the tax on all that growth will be due.
Okay, next up, the lump sum. This one is as simple as it sounds. Boom. You get all the money right now in one single payment. It's the fastest way to get your hands on the cash, but there's a pretty big catch you need to be aware of. And here's the classic dilemma, right? The upside is fantastic. You have total control of all the money immediately. But the downside, it can be a real punch to the gut. Taking all that money in 1 year means it's all counted as income in that year. That can easily shove you into a way higher tax bracket. And that means a much bigger chunk of your inheritance is going straight to Uncle Sam.
All right, let's talk about a super common one, especially for non-spouses. It's called the 10-year rule. Just think of it like this. A clock starts ticking, and you have exactly 10 years to withdraw all the money from the account. The best part? You've got tons of flexibility inside that decade to plan things out and manage your taxes.
So the real power here is that you can be strategic. Got a year where your income is a little lower? Great, maybe you pull out a bigger chunk then. You get to play with the timing. But that deadline is a hard stop. By the end of year 10, that account has to be completely empty. No exceptions.
Now, there's a cousin to the 10-year rule called the 5-year rule. It works pretty much the same way, but, well, you only get 5 years. This is often the default option for non-qualified annuities if you don't pick something else. The catch is, with only 5 years, you have a much shorter window to plan your withdrawals and manage that tax hit. Okay, let's shift gears and talk about maybe the most critical piece of this whole puzzle, the tax impact. Seriously, this is where people can make some really expensive mistakes if they're not paying attention.
Let's just boil it down to 3 simple rules you got to remember. Rule 1. If it's a qualified annuity, every single dollar you take out is taxed just like your regular paycheck. Rule 2. For a non-qualified annuity, it's a little better. You only pay tax on the gains, the growth, not the original principal. And Rule 3, and this is a sneaky one, that withdrawal money counts as income, which might be enough to make some of your Social Security benefits taxable when you didn't expect it. Okay, if you remember one thing about taxes from this, let it be this. Annuities do not get a step up in basis. I know that sounds jargony, but here's what it means. When you inherit something like a house or a stock portfolio, the tax man kind of wipes the slate clean. But with an annuity? Nope. All that growth that happened over the years, that's now your tax bill to pay. You inherit the money, and you inherit the tax liability on the gains.
All right, that was a lot of information, I know. So let's pull it all together into a simple playbook. Think of this as your cheat sheet to help you figure out your next steps.
So look, it all goes back to those first two questions. Are you a spouse and you don't need the money right now? Spousal continuation is probably your go-to. Are you a non-spouse with a qualified annuity? Then it's time to map out your 10-year plan. What if it's non-qualified? You're looking at choosing lifetime payments or using that 5-year rule. And hey, if you just need the cash, like yesterday, then the lump sum is there for you. Just be ready for that tax hit.
But at the end of the day, this decision isn't just about the math or the taxes. The real question is, what do you want this money to do for you? Do you need it to wipe out a mortgage? Do you want it to create a steady income stream for your retirement? Or maybe it's about building something for the next generation. Once you know the answer to that, you'll know which path is truly the right one for your future.